The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
It's my pleasure to welcome to today's programme two great friends of mine and two old guests of the show, if you like. The first up, we have Jonathan Davis. Jonathan Davis is an economist and a wealth manager. He's in charge of Jonathan Davis Wealth Management. Hello, Jonathan. How are you doing?
It's lovely to be here, Dominic. I'm really great. And for once I can say it's not freezing.
Good stuff. Yeah, it's a lovely mild day today. And I'm also speaking to Mike Hampton. Mike is in London. Michael Hampton is a private investor and an author. And again, another old favourite of the show. Michael, hello. How are you doing?
I'm very well and enjoying the London weather today.
Excellent stuff. Now, we had a bit of a correction in the markets yesterday. The Dow was down by about 50 points or so, but gold was absolutely hammered. Gold was down by, at one stage, almost $100 on the day. And Jonathan and Mike, we're going to start by discussing the markets generally. And before the show began, Jonathan, you said that you thought we might have hit some kind of turn. So why don't we start with that?
Well, yes, I did say that. Of course, as with everything, nothing's guaranteed or definite. But I've been watching these markets daily, perhaps hourly, I don't know, for the past few weeks. And when I look at, say, the FTSE or the transports or the Russell 2000, I have not seen any advancement for literally 4 weeks now. And I've been seeing these internal indicators like the MACD, the stochastics, the RSI, all that kind of stuff, at really extreme levels. And I've been thinking to myself, this is going to burst pretty soon. And I just do have the view that yesterday, with the announcement of the ECB's LTRO number 2, and who knows what ISDA today say about whether or not Greece is actually defaulting. Goodness knows how they get away with saying that so far they haven't defaulted, but that's the shenanigans that these guys get up to. Yes, I think there's a big change happening now. I think it started yesterday. I think March is going to be a significant down month. I'm not saying that we're going to be going down all the way now to the end of the year, because it could well be like 2011, where we had a down, then an up, and then a big down. Or indeed, it could be down all the way to the end of the year. One final point, I do think that this year is going to be a very big down year.
Very good. Jonathan, thank you for that. Michael, over to you. We have, by the way, next week, the PDAC, which is the biggest mining conference in the world. And every year, like clockwork, we seem to have a huge correction around about the time that the PDAC happens. Is this just a normal seasonal correction, Mike? A little 5% pullback in a bull market? Or is it something bigger than that?
Well, I think it could be something bigger. What was interesting about yesterday was the high volume. And also it was what's called a wide-ranging bar. There have been bigger drops over the last year, but this particular drop, at least during New York trading hours, which creates the bars are only actually created during the trading hours, it was the biggest downwards bar that I can find in the charts. So, and also the average volume in the GLD is in the region of about 12 or 13 million. And this volume yesterday was over 40 million. So for those two reasons, I think the gold market has announced that something new and significant is afoot here. It is, as you said, in the window of the PDAC. It's a little bit earlier. Sometimes the drops will come during or after the PDAC. This is sort of just before it. So the timing for a drop is about right. And the last thing I want to mention with respect to the gold price is, I like to look at charts. And I think one of the interesting charts to look at today, I posted on my website, which shows the GLD versus the DBA. And the DBA is an index of agricultural prices. And what's interesting is a lot of the highs and lows in the gold match up with the highs and lows on the DBA. But gold has really outrun the DBA by quite a considerable margin. And I think it's had an outperformance over the last 5 years or so of something like 150% relative to the DBA. And I know a lot of people look at gold as a way of preserving wealth and staying ahead of inflation. But I think if the gold bulls are honest, I think they're really hoping and expecting an outperformance beyond inflation. And we've seen that over the last year or two. So maybe gold is due a more significant correction to bring it back in line with some of those other measures of inflation that people seem to have forgotten about, like the agricultural price.
Okay, well, Mike, I'm going to come to the broader stock markets, but let me just defend gold here. Gold's still trading as I'm looking at my screen now. Gold's at $1,720 an ounce. It's up 10-15% on the year, something like that. Began the year at 1550. If you look at the gold chart, and if you believe in these kind of voodoo things, there's a lot of resistance just between 1800, and it's just a natural place for gold to find a correction. It's still in an uptrend. It's tracing out an inverted head and shoulders pattern with the right shoulder at about just below 1800. And I just don't see the gold price falling below 1600 from here. My big theory on gold is that we got too far ahead of ourselves in September, and we're going to be in for from September last year, we're going to be in for a year or 18 months of sideways whipsawing action, just as we were after May 2006 and February 2008. So I remain a long-term bull about gold, and even though yesterday was a big one of those, it was a big kahuna of a correction, there's probably still more to come, I'm still defending gold.
Well, I'm long gold, and I buy gold on dips and I sell it on rallies, but retain a core gold position. I still have that. But can I just question that a little bit? I do think it's a legitimate argument, but I'd like to just take it a little bit further and say, what do you really expect of gold? Because I think there are two possibilities. One is that, gold is hedged for inflation. It got way undervalued back in 2000, 2001, and then it reached fair value relative to various inflation measures sometime above $1,000. And let's say now between maybe 1,000 and 1,015, maybe 1,016. But I think a lot of the gold bulls expect gold to outperform these measures of inflation. And I think that's a legitimate argument provided gold becomes a currency. It gains seigniorage. It gains preference as a currency ahead of fiat currencies and ahead of other currencies. And I think that's what the gold bulls are really expecting and hoping for and praying for. And it may happen, but it may not. I don't think it's a guaranteed thing. And I have said, and I'm very controversial about this, I seem to be the only person speaking this way, that, I think gold has a role as a wealth preservation, but I don't think that we should really look at it as a currency and something that we want to pin our currencies to, because the gold bulls would have us pinning our currency to gold when gold's at some kind of a high, and that would then protect them from a cyclical downturn in the gold price. And I don't think that's going to happen, and I don't think it's a good thing if it does happen.
Dominic,
I was going to say, Jonathan, what's your take on gold? Yeah.
I would actually very much agree with Mike there. So, in fact, he's not on his own. I think that the euro is acting now like the 1930s gold standard and pushing the EU into depression. So I agree absolutely that to go on to a gold standard now would be contra helpful. It wouldn't be helpful at all. In terms of trading gold, shortish term, in other words, months rather than weeks, I think we have to bear in mind that the dollar, in my view, probably bottomed out for the intermediate term last summer, autumn, and has been rallying hard since then. And I think it's going to soar this spring and summer and maybe autumn. And on that basis, that's the reason why I'm very, very short-term on gold for this year. In the long term, if you look at the long-term chart, I know there's great problems with Elliott wave theory, but I think in the long term, you can probably make a case that at 1900 last year on gold was actually the end of wave 3. And wave 4 is what we are in since last spring, summer, which could conceivably take us down to the last major high, which was 2008 of 1200. And certainly my view is that this year we're going to go below 1400. Long term, absolutely. I think after the crash that I believe we're going to see this year, there will be yet again massive money printing by various major central banks. That again will create inflation in goods and services, and gold I can see in 2, 3, 4, 5 years at $3,500.
I've seen so much Elliott wave analysis not work, but in the gold chart I can see exactly that pattern that you've described. Wave 1 to May 2006, then a correction. Wave 3 to 1900, then a correction, which I can see that interpretation. But Mike, let's now get your take on the broader markets, and then Jonathan will come back to you.
Yeah, I made a forecast a couple of months ago, into the year, that we would see a big sell-off this year. And I was particularly worried about Q2, probably the end of Q2 into July. And I still think that's a period of great danger. The markets performed a little bit better here going into the end of February than I expected. And, it looks like it's topping out. I agree with Jonathan on that. And, I think we could see some kind of an important low around July and then maybe a rally. And I think it's possible, especially if we get the dollar rally that John's talking about, we could see a very sharp drop in stocks during this downturn. So if we see a sharp drop into July, there might be some sort of a bottom there. If it's more gradual, then perhaps we will see the more gradual and steady downturn that Jonathan was referring to.
Okay. Now, Jonathan, what's the second issue you'd like to talk about today? There were three things you wanted to talk about. One was the stock market, one was the economy, and one was the housing market in the southeast. Should we talk about the housing market in the southeast next?
By all means, but I just want to add, if I may, about the stock market, because I haven't really commented fully on that. I wrote to clients just last week that I think the only reason why the markets haven't totally and utterly collapsed is simply because of European quantitative easing, whatever they want to call it, money printing for the last year or two. I don't believe, or should say I do believe, that the markets have not truly priced in Greek default. And I think Greek default is going to happen. And then, of course, immediately behind that is Portugal and Spain, Ireland maybe again, Italy. We're talking trillions of euros, dollars, whatever, that the global financial system cannot accommodate. In 2008, companies were going bust. Now, countries are going bust. And the fact that the US bond market is at levels of 2009, and yet the stock market is diametrically opposite. I think the stock market is telling porkies left, right, and centre. So I'm looking at I don't know the route, but I am looking at a 40% fall in the stock market this year from this week.
That's interesting. Let me comment on that before we move on to house prices, if I may. My target I mentioned before is 850 S&P, so that's that's probably right around what Jonathan has in mind. If we see that in July, look for that as a bottom. If we are much higher in July, then maybe it will run on longer. As far as Greece and Europe goes, I agree with what Jonathan said. I think what we've got in Europe right now is we've got some elections. And a game has been played in such a way as that politicians who are still in office have a chance of getting reelected. And the Greeks in particular have stuck their hand out and said, we'll do what you want, give us the money, and they're going to get it. They've gotten it. And they're going to get the debts restructuring haircut that's been talked about. But, moving forward from here, the Greek economy is not going to perform. And the Greeks are going to be in a position where they really have to default because they won't be able to meet the now agreed terms. And as Jonathan said, there are a couple of countries, maybe three, right behind them, ready to go through a similar process.
Nasty stuff. Right, let's discuss everyone's favourite subject, the housing market in the southeast. It's been a beneficiary of all the problems overseas. People are buying central London, overseas buyers are buying central London property for the same reason people buy gold, I think, as a kind of hedge against risk in order to get their money offshore. It's been a beneficiary of the weak pound. This has all meant that we've kind of had a 20% correction in property outside of the M25, and then within kind of zones 1 and 2 and maybe 3, the housing market's up by about 10%. What do you make of that divergence, Jonathan? Let's start with you.
Yeah, that's a fair analysis. I think probably the foreign money that's come in has been less about reducing risk from a financial point of view and probably reducing risk from a political point of view. Let's face it, they hardly have stability in much of southern Europe or indeed in the likes of Russia or indeed China. Yes, quite simply, when they bailed out the global financial system in 2009, they bailed out the United Kingdom. In other words, they bailed out the south of England because the south of England economy is banking. And on top of that, the illustrious Mervyn King, a.k.a. Benny Hill, slashed the interest rate farther and faster than in history to what is effectively the lowest interest rate possible. Of course, they cannot do that again. And I find it fascinating that with the lowest interest rates ever, we don't see house prices rising 30% a year. In fact, as you say, in most of the southeast of England, prices are actually falling. And in central London, I would disagree that prices are rising in zones 1 and 2 and whatever. Certainly in absolute central London, then yes, they are very marginally rising. But the rest of London and certainly in the rest of the southeast, they are falling, admittedly marginally, but they're falling with the lowest borrowing costs ever. And that is because banking is now in long-term decline. Last year, globally, the global financial industry lost over 200,000 jobs. In the City of London alone, it was 25 to 30,000. That will happen again this year, bearing in mind last year was before we even had an economic and financial collapse again. So although they will continue to bail out banking for as long as they can get away with it, it will not have the same impact as the 2009 did. Thus, London and the southeast house prices, the market has already collapsed in the sense that numbers of transactions are down 40 to 50%. And I'm sure Mike will agree that where volumes go, price generally follows.
Yeah, I mean, the volumes are just incredible. Mike, over to you.
Okay, well, I wrote down some bullet points here, so I'd like to go through there first before picking up on something Jonathan said. I think there are three positive things that have helped the housing market in the UK. John's mentioned one, at least one of them, and I'd like to enumerate those. One of them is very rarely mentioned, but I think it's quite important, and that is that London is the ultimate walkable city in the world. In some ways, it's better than Hong Kong, which is one of the other good ones. And this is a place where you can live. You don't need a car. You have access to wonderful transportation most of the time. You have access to wonderful culture. You have a lot of jobs here. And through all that, you don't need an automobile. And although gasoline prices are high and might be going higher, this is quite a wonderful place for people to live. And that's an enduring advantage that London's going to have in the future. And I think it's mostly underrated. And that's actually, a good thing because, it is a very, very livable place. So the second thing I wanted to mention, which is perhaps not quite so enduring, is the massive amounts of money that are coming from overseas. I mean, here you always hear about the Russians, the wealthy Russians, and even the Greeks now who are escaping to London as a safe haven. But what I see in Hong Kong, where I live, is I see the builders coming through on a regular basis, bringing 2 or 3 new developments per weekend for sale, and in major hotels in Hong Kong are full of these shows. And I think something like 30% at times of these developments are being sold in the Far East, largely in Hong Kong and in China. And I don't think that's going to be so enduring. Right now, there's a lot of money. Interest rates are low in Hong Kong still. People can get money out of their properties, or they're selling properties at very high prices, and they're putting some of the money into London as a hedge. Things can change, so that won't be happening anymore. And if we see the Chinese and other foreigners turn sellers rather than buyers, a very important positive aspect in the market will be pulled like a rug right from under the market. The third thing, which Jonathan also mentioned, is interest rates. These are the lowest in history. They're incredibly low. And in the last year or so, the percentages that lenders are willing to lend have been picking up as well. I think you can get some pretty interesting deals now at 80-90% loan to value. And that's probably helped to create this last little fill-up, this last little rise, which to me is nothing more than some pre-Olympics hype. And I think once those Olympics are out of the way, we're going to see rents coming down, and we're going to see the rug well and truly pulled on London house prices.
Can I want to add, sorry, Dominic, on the subject of lending, because Mike's not here, he may not know, but actually pretty well, something like 75% of the market now, you pretty well cannot get a high loan-to-value interest on the mortgage. Essentially what you're looking at now is normally 50% interest on the mortgage, maybe 75. That was a major boost previously to the London market. It has been taken away. Not it's being taken away, it has been taken away. I think Mike's right. The Olympics is the end point.
But let me just agree with you. I mean, I think what I'm talking about really is a trickling back in of some of those high percentage loans, maybe some first-time buyers are able to get them.
Mike, it's small beer. It's like 100 or 200 million pound availability per deal. They're just marketing gimmicks. It's not the reality.
Okay, thank you.
We've kind of touched on the economy, Jonathan. Do you want to just talk about the economy generally as we close?
Absolutely. I think it comes down to this. We had 30 or 40 years of rising debt in the West and then indeed in the East. And the level of debt now globally is more than we've seen in human history. And we are now in an era of deleveraging. Indeed, the ECB made some cheap loans to 800 banks in Europe just yesterday. Just an aside, how come there are 800 banks in Europe? That's just crazy, but that's just an aside. And these banks have to pay back. They have to delever 3 trillion euros over the next 3 years. Now, that is serious deleveraging. And what with the collapse of houses all around the world, and indeed it'll happen in Canada, the United Kingdom, it's already happened in most of the UK and Australia, obviously in most of the EU, and it's happening in China right now. Clearly, that's where a lot of the loans are. But just give you another historical context here for the UK. The last time the UK had even remotely close to the level of debt that we have now, and yet it was still only about 2/3 of what we have now. Was 200 years ago, following the Napoleonic Wars. And you know how we got out of it then?
Wow.
Two little things called industrialization and the empire. My point being, we're toast. You're right. Interest rates are not going to rise for a long time, because on the face of it, we are all Japanese now, in the sense that we've got zero interest rates for a long, long time to come, or at least we have to go through significant deflation before we will get super or hyperinflation. China is in recession as we speak. The EU is in recession. The UK is in recession. And the US would be in recession other than the inventory restocking that took place in the second half of last year. In fact, I believe that the US is probably in recession again. Did you see the durable goods numbers yesterday? -4%. That's most of the global economy in recession as we speak. In essence, we're in an era of deleveraging, which means 20 to 30 years of depression.
Mike, go on, save us from the gloom.
Well, I'd like to tie together 2 points, one that each of you made, and then finish with a positive. Finish my comment with a positive one. The two points I want to focus on is, Dom, you mentioned interest rates might stay low for 2 years. And Jonathan's talking about the debt crisis spreading across Europe. I think one thing that people don't give enough probability to is the possibility that what we saw in Greece and may soon see in Portugal and other countries might spread to the UK. There might be some disruption in the bond market, which will make it, and I know we control our currency here, but it may become difficult for the UK government to continue to have low interest rates, especially on bonds. And if we didn't get quantitative easing from here to eternity and keeping rates low, but instead got a rise in rates, that would put a real nail into the coffin of the property market. So I think we have to be aware that there might not be 2 years of low interest rates, especially 2 more years of low long-term rates. So I'd be careful about that. The positive thing I want to point towards is something I've picked up in the last couple of days here in the UK. It was a bit of a surprise, but I see a new sort of meme coming forward. And it seems to me that the government here wants to embrace something positive and move away from talking about austerity. And that new thing they want to embrace is the green economy. So I think that's going to be something we're going to be hearing and talking about a lot more in the future. And I'd like to end it on that.
Okay, well, Jonathan, where would you put your money? And Mike, I'm going to ask you the same question as we close.
Yeah. Personally, I'm heavily short right now. And for our clients, we are somewhat bearish in a 30, 40, 50% fall in the stock market this year. If that happens, our clients will make just about double digits. We will then move from bearish to between mildly and very bullish, depending upon what we see at that point.
And if the stock market rises?
Then our funds are such positioned that whereas the stock market has risen 25% in the last 3 months, we've gone down a couple of percent. So we're just waiting for. But you have to understand that the bull market started in March 2009. That's clearly about 3 years ago. Average bull markets are 3 3/4 years, but as I say, countries are going bust.
Very good. Mike, where would you be investing your money?
Well, I'll tell you where I am investing it. I'm largely in cash just right now. I have one property which I'm in the process of selling. And I have a number of, I think, are fairly cheap resource stocks. which are now beginning to show some profits. And I'm wondering if they're going to endure, if we get a gold sell-off, whether they're going to do okay. But I'm holding on to those as a kind of hedge. I've got a little bit of gold, and I'm getting ready to buy puts again. I did have some puts earlier this year, but the last couple of weeks I've really slimmed that down. My market went a little bit higher than expected, but I will be buying puts again. But the number one position I have is cash. That cash is in Hong Kong dollars and Canadian dollars mostly.
Oh, yes, and we've also put money into US dollar as well, because we like the dollar at the moment.
Very good. Well, Jonathan, do you want to give out your website as we close? By the way, I should say I'm a bit more positive than you two, so I want you, the listener, to take some positivity away from this conversation. But Jonathan, what's your website?
JonathanDavisWM.com. WN stands for Wealth Management.
Very good. And Mike?
I have two domain names that lead to the same site. I'll give the one I don't usually give, I'll give this time. It's greenenergyinvestors.com.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.
Say the FTSE or the transports or the Russell 2000. I have not seen any advancement for literally 4 weeks now, and I've been seeing these internal indicators like the MACD, the stochastics, the RSI, all that kind of stuff, at really extreme levels. And I've been thinking to myself, this is going to burst pretty soon. And I just do have the view that yesterday, with the announcement of the ECB's LTRO number 2, and who knows what ISDA today say about whether or not Greece is actually defaulting. Goodness knows how they get away with saying that so far they haven't defaulted, but that's the shenanigans that these guys get up to. Yes, I think there's a big change happening now. I think it started yesterday. I think March is going to be a significant down month. I'm not saying that we're going to be going down all the way now to the end of the year, because it could well be like 2011.
The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
It's my pleasure to welcome to today's programme two great friends of mine and two old guests of the show, if you like. The first up, we have Jonathan Davis. Jonathan Davis is an economist. Was absolutely hammered. Gold was down by, at one stage, almost $100 on the day. And Jonathan and Mike, we're going to start by discussing the markets generally. And before the show began, Jonathan, you said that you thought we might have hit some kind of turn. So why don't we start with that?
Well, yes, I did say that. Of course, as with everything, nothing's guaranteed or definite. But I've been watching these markets daily, perhaps hourly, I don't know, for the past few weeks. And when I look at...
and a wealth manager, he's in charge of Jonathan Davis Wealth Management. Hello, Jonathan. How are you doing?
It's lovely to be here, Dominic. I'm really great. And for once I can say it's not freezing.
Good stuff. It is a lovely mild day today. And I'm also speaking to Mike Hampton. Mike is in London. Michael Hampton is a private investor and an author. And again, another old favourite of the show. Michael, hello. How are you doing?
I'm very well and enjoying the London weather today.
Excellent stuff. Now, we had a bit of a correction in the markets yesterday. The Dow was down by about 50 points or so, but gold was